Good morning, ladies and gentlemen. Yeah, I'm the old codger who said, I remember it well. If you want to put yourself in the right frame of mind, just double the tax rates. Corporation tax started 40%. Income tax was then 41.25%. Surtax, which was on top, was 50%, making a total of 91.25%. But even that's wrong because there was a retrospective 10% surcharge on surtax, which made 96.25%. Doesn't bear thinking about, does it now? Well, as I say, I remember it. I remember queuing to get my copy of the finance bill. I brought along my copy of the Finance Act. 270 pages to introduce 2 new taxes. Small pages, too. And then I took the Institute of Taxation exams in 1966, so I studied corporation tax right from the beginning. And I reckon I passed because I could work out corporation tax at 40%. But just you try grossing up pounds, shillings, and pence at 41.25%, or if you prefer 99 over 240, without a calculating machine. I bet you couldn't do it. Of course, I couldn't do it either, but I suppose my method was right, so I passed on that. I have some recollections. I won't bore you too long with them. I remember a loan stock trustee who was getting concerned about assets being shoved around the group rather a lot. And the partner I was then working with said, what on earth are they doing? And so I said, well, they were just making their gains and losses in the same company. And that was the rational thing to do. So if there was a problem with the loan stock, he better sort it out on sort of company law grounds, which was just what he wanted to hear because he didn't understand about tax. And then I got into an argument about the transitional provisions about paying dividends. Of course, if tax was deemed to be deducted from dividends before and was actually deducted from dividends after the introduction of corporation tax, then you paid all your dividends before if you possibly could. And I got into this argument about whether a subsidiary could have a main purpose of avoiding the parent company's corporation tax or something like that. Anyway, we dragged it out for 10 years. It ended up in the High Court in 1976, and of course we lost. And I remember we had a young barrister called Andrew Park. The thing I really remember, and it stands out today, is shortfall, close company shortfall apportionments. If you went to a tax meeting in the period just after 1965, nothing else was being talked about but this. And you had to distribute 60% of a trading company's income, and you could hardly pay any director's fees because that was limited as well, unless you could show that the requirements of the company's business made it that you couldn't. And that included, and it still trips off my tongue, requirements necessary or desirable for the maintenance and development of that business. Well, you can imagine what arguments led to that. And of course, the revenue had to take a terribly tough line because everybody said, well, we're going to build a new factory. And so they said, well, where are the plans? And things like that. So that was my real recollection of the early days. But funny how history repeats itself, because if you say, well, today's tax rates are half, well, the differential between the corporation tax rate and the highest rate of income tax is exactly the same differential as it was then. So why don't we have close company apportionment? Well, I won't give anyone any ideas about that, but let's get on to the serious business of this conference. And the first speaker is Professor Peter Harris from Cambridge, who's going to talk about the history. You better be very careful what he says.